So is this one of those calls, Tony, where you've seen a short-term bottom, but not the bottom for the bear market?
Yeah, Sarah, it's throughout this whole year we've talked about a low versus the low. And historically, it would be, unfortunately, it'd be historically unique since it's been a 500 stock index for the S&P 500 to make the low before the 2-year bond yield made its peak. So if you count last Thursday as the peak in the 2-year bond yield for the entire cycle, that would have meant for the first time in history since the mid-1950s, the S&P bottomed before bonds.
So you're not convinced that, we've seen the highs on the yields?
Well, it really comes down. No, I've been wrong on that already. So I don't think the yield should have gone up so much. I don't think the Fed should be raising rates so much. But ultimately, the call from here is that when we were coming out of the summer rally, we talked about the fall on the show. And what comes after that is the year-end rally. Just because you were so oversold, Sarah, in early October, on October 3rd, 8 of the prior 9 days had less than 10% of the S&P 500 above their 10-day moving average. The VIX was at 32. My weekly stochastic for the S&P was in the low teens. All of the sentiment measures were historically pessimistic. So whether it's a bond move or a currency move or all of the above, the market was like tinder, waiting for an oversold bounce. But again, the whole reason that you really need lower rates, as you know, comes down to if we have weak economic data coming, which I firmly believe we do. All the yield curves are telling us that. What you need is a way to look through that coming weakness. And that's what a dramatic reduction in bond yields does. It allows investors and traders to look through the economic and earnings weakness so that they're comfortable buying and holding stocks. And I just don't think we're at that point yet.
No, I think, we've got a Fed meeting. We've got a Fed trajectory that's sort of unclear, Tony, because they don't know themselves how fast inflation is coming down. What are you gleaning from earnings right now, which always gives us a really good window, I think, into those issues like earnings and like the economy, and certainly that the Fed should pay attention to?
Well, we haven't had enough time, Sarah. I mean, think about it. 6 months ago, they're still buying mortgage and treasuries and quantitative easing. Interest rates were at 0%. The government was giving us money. At that point, it takes time. For example, if you're a company management, which many of the viewers are, you're hiring somebody 4 months ago, you had to pay a bonus just to get them to walk in the door. You don't turn around within a couple of months and let them go. You need more durability in economic weakness that we haven't had yet. So our call for next year is that earnings will be about 5% below this year. And again, that's some margin compression, some weakness on the top line. But I think
that's not recession, though. Is it?
Well, no. So back in the
1970s,
in the last inflation-related period, the way I came up with that is when nominal growth stayed positive, meaning sales growth in the 1970s, because of the higher level of inflation, even when it came down off peak. So where it really comes down to is the margin compression. And the margin compression, I just took a median of the margins for each sector going back from 2013 to 2021. So ultimately, it's a guess to begin with, but I think you put it to the right point. It's all about interest rates and the ability to look through the coming weakness.